All right, as I said, my name's Tom Ahola. I'm one of the advisors here at Reddick Real Estate. Thank you for taking time out of your busy schedules to join us. So, a little bit of housekeeping before we get started here. If you're new to Reddick, if this is your first webinar, here's a little bit of information about what we do here as a company. What's unique about Reddick is we are a one-stop shop, the trifecta of real estate. We are not just a real estate brokerage, so we don't just help buy and sell properties. We are also a private money lender for those deals that need help getting closed, as well as a property manager to help maintain the assets that you acquire. Very unique business model. Nobody else out there is kind of doing it on the scale that we are in multi-states and all kinds of investment strategies. We make it possible to purchase residential real estate in carefully selected areas of the United States. Our organization provides real estate brokers, contractors, property managers, and access to top resources such as lenders, CPAs, insurance agents, attorneys, and 1031 exchange accommodators just like Dino. So now, a little bit about myself. Again, my name's Tom Ahola. I've been with Reddick for some time now. I love this company. I love being here. I love the team, and I love all of the vendors who help us get our deals closed every day. I have assisted clients both in-state and out-of-state in single-family and multifamily transactions. I do actually specialize mostly in California multifamily real estate. However, I've had multiple closings just this month as well for different properties, single family, duplex, triplex, you name it. I'm a licensed California realtor, of course, and I do actually have my degree in real estate with a passion for educating. I come from a family of teachers and educators, so save all those questions and feel free to ask as many as possible. There's no such thing as a silly question. Okay, now where do we do business? So this is a broad scope of the majority of the states that we operate in, but we do have brick and mortar locations here in the Los Angeles area, Orange County or Newport Beach for us locals. We do also cover Riverside and agents in San Diego as well. We have an office in Cape Coral, Florida, which also services Port Charlotte. We have referrals in Boise, Idaho area, Nevada, Arizona, as well as Kentucky. We also do have an office in Clarksville, Tennessee, San Antonio, Texas, Austin, Texas, and a couple others coming soon. Now, here's the biggest question, what everybody always asks us to begin is, where should I invest? Now, there's a reason why we picked the specific markets that we are operating in. Number one is the job market. We always look for states and cities specifically where there's a ton of job growth. There's a lot of job diversity, which means that if there ever is a recession or a certain aspect of the economy is affected, you're going to have that diversity to avoid that issue. We also look for a low vacancy rate. We are always paying attention to market trends, and we pick states and cities specifically where the vacancy rate is a lot lower than the average. We also look at economic diversity. That kind of keys into the job market we were talking about prior, looking at different places that not just have military, education, science, manufacturing. We try and pick cities that have a majority of those check boxes checked. We also look for housing affordability. We don't want to pick a market that's quite too expensive to where you're going to have a lower quality of life because people are paying a little bit too much to live. We also look for landlord-friendly states. If anybody here is looking to 1031 exchange out of California, I can almost assume in the past year or so, you've probably hit a couple of road bumps with California rent control laws and everything we've had going on here. We also look for strong education, like I said, with economic diversity. We also look for places that have good schools and different stuff like that, as well as reliable property management. Now, that is the most important and definitely a topic that needs to be heavily stressed. You can always make a good investment purchase, but if you don't manage it effectively, it's not going to turn into a great investment over time. So we do have our property management set up in each of these markets, so it's definitely something that helps with investments. All right, now let me introduce Dino. She had a short little hello in the beginning, but she is the Regional VP of Asset Preservation, Inc. She has done thousands of transactions with us here at Marshall Reddick, more than a handful with me personally, and we actually have 2 ongoing with Marshall Reddick clients. So take it away, Dino.
Thank you. First of all, Thomas, thanks for inviting me to come and talk about my topic. Okay, I hope everybody's having a good evening. All right, so what I'm going to cover this evening is I'm going to take you through, the reasons why people do 1031. So we're going to cover what the current capital gain tax rates are, and other potential tax issues associated with real property. We're going to talk about what qualifies for investment property in a 1031. So what is like-kind property? There's certain rules that you have to follow. One of them is called the exchange equation. So we're going to go through all of that. So basically, how much do you have to invest when you're doing an exchange? I'm going to take you through the process of the exchange. So basically from the beginning and how it flows to the completion. We're going to talk about some of the key components of the exchange, which is the identification rule. I'm going to take you again through the highlights about, when you're setting up an exchange, what you need to sort of expect. And then I'm going to cover certain miscellaneous issues that we see right now in the current marketplace. Question and answers, I believe that Thomas are going to be sending you the questions directly, and you'll follow up with them after the webinar. That's my understanding. So if you have any questions and you want to jot them down, you can reach back out to Thomas after the webinar is over, and he can either help you with the answer or forward it to me, and I'll be more than happy to address the question. All right, so let's dive on in. Let's talk about what's capital gain rates. Well, right now, there's the federal capital gain rates, there's the net investment income tax, and then there's other taxes associated with real estate. So the existing capital gain rate right now happens to be 15% or 20% if your income is more than $445,851 if you're a single filer. If you're a married couple filing a joint return, then if your income exceeds $501,600, both of those income ranges are going to be at the 20% capital gain rate. So right now, there are 2 different rates for capital gain. The sale of an investment property can easily move you from one tax capital gain rate to another. So just be aware that while you might be in the 15% right now, maybe the gain on the sale of the property could throw you into a higher tax bracket. Also, there's the net investment income tax. Now, people go, what is that? Well, if I call it the Obamacare tax, people know it. That's an additional 3.8% that investors are going to be faced with when they sell investment property if their income is more than $200,000, if they're a single filer, if it's a married couple, if it's more than $250,000. So those are the capital gain rates, the net investment income tax rate. Now, additionally, you have taxation on the depreciation of the real estate. So when you're operating your property as an investor, you're depreciating that property. As you depreciate the property on an annual basis, you are lowering your real estate taxable income while you're operating the property. So for an example, if you have rental income, say of $30,000 a year, and say your depreciation on the property is $5,000. Now, I'm foregoing all the other expenses throughout the transaction, but I'm just trying to illustrate how the depreciation works. Then that you're going to subtract the $5,000 from the $30,000. So you're going to be taxed like as though $25,000, but not the $30,000 that you actually received. Okay. So when you go to sell the property, that has a separate tax rate, and it's called the recapture rate. That rate is at 25%. And then we talked about the federal capital gain rates, which is either 15 or 20%, and then potentially the net investment income tax of 3.8. So as you can see, at the federal level, there are 3 different taxation rates that you could be subject to when you sell investment real estate. Now, and there's also state taxes. Now in California, there is a state tax. Our state tax range is anywhere from 9.3 to as high as 13.3. So these are the taxes that an investor might be faced with when they're selling an investment property. So to sort of drive it home just a little bit, say, for example, as an investor, you have gain on the sale of the property that's, say, over $700,000. I'm just going to use that as a number. If you have gain on the sale of a property of $700,000 and you live in California, then with the California tax plus all the federal taxes, you potentially could be subject to close to $250,000 to $255,000 in taxes. Now think about that. When you're selling the property, if you have to give $250,000 to the government, that means that's less money that you have to buy the real estate. So fortunately, we have 1031 tax deferred exchanges. Now notice I used the word deferred. It's not a tax-free program, but it's a tax deferred program. Okay, in any type of thing, there's always going to be pros and cons. So let's talk about the pros of doing a 1031. Well, one big pro is what I just described. You get to defer the depreciation recapture tax. You get to defer the federal capital gain tax. You get to defer the net investment income tax. And California allows you to defer the state tax. Most states do allow you to defer the tax. There are a couple of states that have some slight little nuances to one state that does not. If you're investing in that state, they don't allow 1031s are not a part of what they do. And that state happens to be Pennsylvania. So the other benefit is that you're building your wealth. So as an investor, you're preserving your equity. So what I mean by that is if, like I said before, if you're selling a property that has over $700,000 in gain, which is not hard to do here in California if you've owned it for a while, okay, I'm not using that money to go and pay the taxes. I'm taking that money and I'm preserving it to go off and buy more real estate. So that gives me more buying power. As in a 1031, leverage can be a very important tool for growing your investment portfolio. So you can utilize leverage. So you get loans, you spend your cash, you get larger loans, you can buy more property. You can diversify. You can diversify geographically. You can diversify by asset class. And we're seeing that diversification right now, both geographically as well as asset class. So what Thomas mentioned a little bit earlier about people buying in other states, that's actually happening. So people do move around from one state to the next. Another advantage to 1031s, at least now under the current tax law, is that people utilize this possibly as an estate planning tool. So in other words, if I'm an investor and I continue to exchange until I pass away, when my heirs inherit the property, under current tax law, there's a step up in basis. When they inherit the property, all the tax on the gains that I have been deferring as an investor is not passed on to them. So 1031s can be advantageous, when you come to estate planning issues. Now, with every pro, there's going to be cons. So let's talk about the negatives of a 1031. Well, one is there's going to be very specific rules and guidelines that you have to deal with, and you're restricted to. So I'm going to cover all of those a little bit later. So we're going to deal with those timelines. Another downside to doing an exchange is the replacement property basis. So when you're selling a property, if you were to pay tax and you bought a new property, you would have a brand new basis in the property. Now, if you're not familiar with the term basis, that means what you paid for the property initially, and then any capital improvements you made to the property throughout its ownership, you add to that, and then you subtract the depreciation. That's how you end up getting to what the gain is on the sale of a property. So when you're doing a 1031, the old basis you had, so whatever your basis was at the time of sale, moves with you to the new property. So you do not get a brand new basis in the new property. So your old depreciation schedule is going to carry forward with you to the new property, unless you buy a higher than what you sold for. Okay, that's something we get into in a longer discussion, but a little in depth, not for tonight. Okay. Lack of liquidity, that's one of the downsides to an exchange. Now, what do I mean by that? You have to buy real estate. So when you're doing an exchange, you're selling property and you're buying property. Any cash that you may wish to keep out of the exchange is going to be taxed, okay? And I'll be talking about a bit later that you can do partial exchanges. But the bottom line is any cash that you touch, you'd have to pay tax on. If you have any losses and you do an exchange and you don't take advantage of those losses, now you have to wait, all right? So it's always important to make sure that when you're considering selling investment real estate, that you are talking to your tax advisor to determine, in your case, based on your tax situation, whether you need to or should do a 1031, because maybe you have some loss carry forwards and those loss carry forwards are enough to offset any gain on the sale of that property. Okay, very important. Keep your tax person in the loop when you're selling investment real estate. Is there a possible risk of higher taxes? Yes. Okay, that's on the table right now. We don't know what that's going to look like because they're still dealing with all of that up in Washington. And again, like I mentioned, it's tax deferred. It's not tax free. Okay, so as I mentioned, that there are going to be some guidelines and restrictions that you have to comply with. So the 4 basic guidelines when you're doing a 1031 tax deferred exchange is, first is going to be the property qualification. So is the property that you're selling, is it real property that's been held for trade or business or for investment? So in other words, it can't be your primary residence. So if you're living in the property, so I'm stressing that, if you're living in the property, okay, that's not a 1031. It's investment real estate or property that you're using for your trade or business. The next requirement for doing an exchange is going to be how much you have to spend. Now, sometimes people think, well, if I'm doing an exchange, don't I have to just reinvest the gain? And the answer to that is no. When you're doing an exchange, you need to qualify for the full tax deferral. You need to purchase property that's equal to or greater than your sale price net the closing cost, and we're going to address that later, and you have to replace any existing debt and spend all of the cash. So that's what you need for full tax deferral. So when you think of an exchange, think of it as a continuation of ownership of investment real estate for a different property in a different location. Okay, you're just basically rolling over your asset into another piece of property. The third basic requirement that's necessary for the exchange is that you have to complete the exchange within a certain period, and you have to identify within a certain period. So you have to identify what you're going to buy by the 45th day, calendar days, and you have to complete your exchange by the 180th calendar day, and these are from the date of the sale closing. We're going to cover this again to fine-tune this a little bit further. And then the fourth requirement, and a very important requirement, is that you have to identify the property according to the identification rules. So when you're meeting these 4 basic requirements, you're staying within what's known as the safe harbors for a 1031. So now what I'm going to do is I'm going to go through each and every one of these items, and we're going to go a little bit deeper. So let's talk about the property qualifications. When it comes to the term like kind in a 1031, it's not uncommon for people to think, oh, well, I'm selling a single family rental, therefore I must have to purchase a single family rental. Or if I'm selling an apartment building or a shopping center, I need to buy that type of product. The reality in a 1031 is that as long as you're buying real estate, okay, that will be held for trade or business or for investment, the type of real estate that you sold, okay, the investment real estate that you sold, you can exchange into a different type of property. So for example, if I'm selling an apartment building, maybe I want to buy a single tenant, triple net building that, has a Taco Bell as my tenant. Or maybe if I want to get into an industrial building, or if I want to get into from an industrial building, go into apartments or go into single family rentals. So as you can see, like kind is very, very broad. The key is that you're buying and selling property that's held for trade or business or for investment. Now, what does not qualify for like kind property is if you're buying into a property that you intend to live in immediately. That will not work for a 1031 because your primary residence is not considered investment real estate. So you cannot sell investment real estate and buy a property that you're going to live in right away. Can you use it for maybe future to convert it into your primary? Yes, but you still have to have a timing of when you can do that, okay? So Like-kind property, very, very broad. So just keep this in mind when you're thinking about a 1031. I'm selling property that's I've either held for trade or business or for investment, and I need to buy real property that I've held for trade or business or for investment. Very, very broad. Now, let's talk about the second item that you have to deal with when you're doing a 1031, how you have to spend all of the cash and replace any existing debt. So again, this is what we call the exchange equation. So if I were to sell a property for $900,000 and I had a loan on the property at the time of the closing of $300,000, there's going to be some closing costs. So the closing costs, say, are $60,000, that means I'll have $540,000 of cash to spend on the new property. If I go out and I buy replacement property of $1.2 million, I put my full $540,000 cash into the new property, okay? And then at that point, I'm getting little bit larger of a loan, right? So I can complete the purchase of 1.2. That's an example of utilizing leverage, okay? Then in this instance, I would have no boot. I've accomplished full tax deferral. Now, when you hear the term boot in a 1031, it's not the shoe wear, okay? It's basically taxable. So the word boot in our industry just simply means taxable. That's the portion that you would pay tax on. So this example here showed you that you can sell for 900, buy for $1.2 million. You spend all the cash, you increased your leverage, so therefore you would have a full tax deferral. Now, I want to explain that while I'm only showing an example of one purchase, you can still accomplish the same thing by maybe buying 2 or 3 properties. That you can do that in an exchange, okay? So if I bought 3 $400,000 properties, and as long as I'm spending all my cash and allocating the debt the way I want to, I'm still going to be okay because I bought higher than what I sold for. Now, let me show you an example of a transaction where somebody might be buying less than what they sold for, okay? So if I'm selling for 900 and I buy a piece of property for 700,000, I'm already going down in value. So that tells me as a taxpayer, I'm going to have some, if I'm not buying any other property, I'm going to have potentially a taxable event because I'm not buying equal to or greater than my sale price net, the closing cost. So if my debt is 300,000, my closing costs are 60, I have cash of 540,000. When I buy the new property, I get a new loan on there of 300,000, and I put the full $400,000 cash down into the new property. So in that instance, I did not spend all of my cash. So therefore, I would pay tax to the amount of gain on the $140,000 that was not reinvested. Now, does that blow my exchange? Did it make any difference that me doing this exchange? Well, that depends. In this instance here, if my gain on the sale of the property was, say, 300,000, and my boot, the portion that's not reinvested, is 140,000, I'm still benefiting from doing an exchange, even though I'm buying less than I sold for, because I'm protecting tax on the other $160,000. Now, if my gain on the sale of this $900,000 property happened to be $100,000 and my boot is $140,000, am I benefiting from the exchange? And the answer to that is no, because my boot, the non-reinvested portion, is higher than the actual tax on the gain that I would have paid if I just sold the property. So I'm going to pay the tax on that $100,000 like nothing happened. So if you're considering a partial exchange, it's important to know what the calculation is and if you're still going to benefit from the exchange. But the good news is it's not an all or nothing system. Okay, so just keep that in mind, because sometimes people go, well, my goodness, if I have some boot, I've blown my exchange, and that's not the case. Partial exchanges are okay. Okay, now let's talk about the closing costs, because I said that it's what you have to reinvest is net the closing costs. So there are acceptable expenses that are going to be a part of a transaction, and there's some expenses that are not going to be. So let's look at the items that are considered acceptable exchange expenses. Well, the real estate commission, because that's the cost of transferring the property, the title insurance premiums, closing fees, escrow fees, any legal fees associated with that transaction, transfer fees, notary fees, recording fees, the qualified intermediaries fees. Those are all costs of doing the exchange. Now, this is not a complete list. There may be some other items that may be a part of that are considered exchange expenses. So for example, if you have a property, say like in LA, for example, and you're paying to relocate the tenant, well, is that paying to relocate the tenant, is that considered an acceptable exchange expense? Is that an expense that can be utilized that you had to pay in order to transfer the property? Now that's a call that has to be made between you and your tax advisor, but these are sort of some of the issues that come up in a real transaction, okay? So it's not black and white. When it comes to closing costs that do not qualify, here are some examples. Prorated rents and security deposits. Now, if you're selling a single family rental, I would say my experience of doing this almost 20 years has been that if you're selling a single family rental, most of the time the people that are buying it are going to be living in the property. So there's really no prorated rents and security deposits. But if you're selling a fourplex or an apartment building or a shopping center or an office building, okay, there's going to be prorated rents and security deposits. A lot of times these items are negotiated on the contract saying, well, the seller will credit the buyer for the prorated rents and security deposits. Well, when you credit the buyer with the prorated rents and security deposits, that means that money is not coming into the exchange. So for example, if my prorated rents and security deposits are $50,000, that means that's $50,000 not coming into the exchange, and therefore that $50,000 is going to be subject to tax, okay? That's an operating expense. If there are points or prepayment penalties, okay, that's a function of finance, not a function of transferring the property. Paying the buyer's closing costs. We see that a lot on transactions where the seller's paying the buyer's closing costs. Okay, that's typically not considered an exchange expense. Now, it doesn't mean that your accountant can't find a way to offset that and mitigate the taxes. You just have to know that that is something that's not considered something that's transferring the property. Any lender policy fees, title policy, impounds such as property taxes and insurance. Okay, so let's talk about this on the buy side, because it's going to see it more on the buy side than on the sale side. If you're buying the replacement property, and I'm seeing a lot of lenders right now, especially in the 1 to 4 space, is looking for the investor, even if you're putting 30 or 40% down, still looking to have impounds, okay? So there may have, when you're closing, they may be requesting that you have 3 months of insurance or 3 months of property taxes. Well, those fees should be paid by you outside of the exchange, because that's an operating cost, okay? So these are certain items that come up that are not a part of the exchange transaction. I always think it's very important to have your CPA, your tax advisor, whoever's doing filing your tax returns, to review any closing statements from your sale and your purchases. That way you can look at these items and you can address those issues specifically with your tax person, okay? Okay, so now let's talk about the highlights of an exchange. All right, so you're thinking about selling an investment property, all right? And now you're thinking, okay, now we want to put this property on the market. I always think it's very important that before you do anything, get into escrows, even before you even get an escrow, I think it's important that you consult a qualified intermediary and you can consult your tax advisor. Why? Because the qualified intermediary is going to explain to you, and that's my role, explaining to you basically what to expect in an exchange. I'm going to go over what you have to reinvest. I'm going to ask you about your transaction. We're going to take you through the process of it itself, so you have an understanding what to expect going forward. You talk to your CPA or your tax advisor to determine whether you should or you need to do a 1031, okay? Now, after you've done that and say your tax advisor says, yes, you need to do a 1031, you're going to pay $500,000 in taxes, okay? Now, when you get into contract, you want to assure that your contract is assignable to the qualified intermediary. So there's certain specific language that is going to be added to both the sale contract and the purchase contract, stating that the the seller when you're selling, the buyer when you're buying, has the intent to perform a 1031 tax deferred exchange. Basically, there's language in there that says that there's no liabilities, delays, and or costs associated with this to either the buyer of your sale property or the seller of your replacement property. Okay, you notify them in writing. Why is this important? Because when you're doing an exchange, we as a qualified intermediary, we're going to be assigned into your contract where we're now becoming the seller on your relinquished property, the sale property, and we're the buyer on the replacement property, the purchase property. So when you're having contracts with parties, you can't just have anybody just step in without the approval of the other party that you've been negotiating with. So that's very important. So this cooperation language is critical to the 1031. Okay, then at that point, the qualified intermediary, okay, we prepare the exchange documents. These documents must be fully executed, which basically means signed. So we prepare the exchange documents. They have to be signed prior to the closing of your sale. So sometimes people get our documents and we're waiting for them to come back, and they're all of a sudden we're getting ready to close, and the client goes, oh, was I supposed to do something with that? Because they're getting, you guys, when you're doing a transaction, the reality is you're getting a lot of paperwork from a lot of different places, right? You have to sign the exchange documents. It's not just a matter of us producing the documents. The documents are not valid until you actually sign them. Once you sign these documents, these are legal documents to a 1031, and now we're officially in your contract, okay, as either the buyer or the seller. Then the next highlight is that you have to identify the replacement property within the 45 days in accordance to the identification rules. I'm going to talk about that a little deeper later. And then the taxpayer has to complete the exchange. So you have to complete all your purchases by the 180th calendar day or your tax filing date, whichever is earlier. Now, let me address that right now because we're in that period right now. When people are selling and closing between now and say December 31st, you're still in the 2021 tax year, but you may not be completing your exchange right until 2022. Well, if you're closing on December, say December 15th, your 180th day is going to be well after your tax filing date, which is when? April 15th or 16th, whatever it's going to be. That means if you want to or need to have the full 180 calendar days, you need to file an extension on your 2021 tax return to give you the benefit of the full 180 days if you need it. So if you close in January of this year, of 2022, then we don't have to worry about the tax filing date because the tax filing date in 2022 is for the 2021 tax year, okay? So very important when you're doing an exchange, especially if you're closing this time of year, do not file your tax returns until you've completed your exchange, or file an extension on your tax returns if you need more time. Okay, now I'm going to take you through the exchange process. So you get your property, you're thinking about selling your property, you sit with Thomas, let's say, and you guys have talked about what you're going to do. You talk to your CPA, your tax advisor, to determine whether you need to or should do a 1031. You've consulted the qualified intermediary. We're going to get the exchange set up. So I would be communicating, for example, with your escrow officer, your closing attorney, depending on what part of the country you're in, getting documents from them, the purchase agreement and the title. We prepare our exchange documents. You make sure that you sign those exchange documents. And then when the buyer brings in their funds, okay, the deed to the property is going to go directly to the buyer. The money from the sale is going to come directly to us as the qualified intermediary. You cannot touch your money. Now, the date of the closing is going to start the 45 and 180 calendar day period. It doesn't start when you're in contract. It starts when you are ready, once it closes. Now, you're going out and you're making your offers on the replacement property. You get under contract with the property. We have to prepare the exchange documents for you to sign. You sign the exchange documents. When you're ready to close, we get ready to wire the funds. So we're going to wire the funds into the seller of the property, the escrow, and then you're going to have the deed to the property. So that's the cycle of the exchange. Now it looks all nice and neat on a slide. When you get in a transaction, it can get a little hairy from time to time. The key thing is when you're doing an exchange is to keep your eye on the prize, and your eye on the prize is tax deferral. So you have to take charge of your transaction and stay on top of these timelines and stay involved. I also tell folks that when you're in this kind of transaction, if you have any questions whatsoever, you need to ask them, because if you don't ask a question that you should have asked, there's certain things that cannot get fixed in an exchange. Because remember, while you're doing real estate, you're doing a tax transaction at the same time, okay? Now, the challenge in today's market is going to be the first 45 days. I don't like to sugarcoat that at all, because that actually is the reality. So you have to identify what you're going to buy within that 45-day period. Now, the IRS gives you 3 rules to select from. The first rule, which is the most commonly used rule, is the 3-property rule. So you can identify up to 3 properties, but you're not limited to the dollar amount of each one of those properties. Now, a lot of people say, well, what if I want to identify 4, 5, or 6 properties? That's fine. Now you're out of the 3-property rule, and you're now moving into the next rule, which is known as the 200% rule. Okay, under the 200% rule, you can physically identify 4 or more properties. However, when you add up the fair market values of all of those properties, the total value cannot exceed 200% or 2 times your sale price. So if you sold for, say, 900,000 and you identified properties added up to, say, 1.5, you're fine, because you're below 2 times the sale price. But if you identified properties valued at $2 million, now you're above 2 times the value of a $900,000 sale. Now you're into the 3rd and final identification rule, which is the 95% rule. Under the 95% rule, you can identify 4 or more properties. There's no limitation to the dollar amount, but here's the catch. You must close on 95% of the total value of all the properties you've identified. So basically, you must close on your entire list. This is not a rule that you want to go toward at all, okay? And if you are going to go to that rule, you better feel very confident that you can close on everything that you've identified. Now, let me address a little bit, what do I mean by identifying? Because sometimes people think that identifying means that if I'm in contract with the property, then that's deemed identified. No, you're in contract with the property. So you've negotiated a contract. The identification, there's a specific form that you fill out for the identification. So even though you may be in contract with the property, and if that property is going to close after the 45 days, then you still have to fill out the formal ID form, okay? And as I said in the guidelines, that identification, if it's not done properly, does not comply with the 1031 rules. So very, very challenging, when you're dealing with the identification rules. When we talk about identifying, you're putting down the address, the city, and the state of each property. I always tell people that when you're looking at your 45 days, if the 45th day happens to fall, say, for example, on a Saturday or a Sunday or a legal holiday, you should get that identification in during business hours before that period. Because if you make a mistake and then we see the identification the next business day, which say would be day 46 maybe, or even day 47, you can't fix the identification. So it's very important to make sure that when you're filling out that form, that you're doing it during the time frame where somebody can review it, okay? You want to check and double check that you've got your addresses and everything correct. Because if you put down 321 Main Street and you buy 123 Main Street, that is not what you have identified, and that's an issue in an exchange. So keep in mind that that is That is very, very important. Okay, so the next is multiple property exchanges. It's not uncommon that when people want to consolidate, they'll sell multiple properties. So if you're looking at selling 3 properties, for example, to buy 1 property, you can do that for an exchange. What you need to be aware of is that the identification in the time frame is going to start at the closing of the first property, the closing of the first property. So when the money comes in, you go out and you buy the replacement property, then you can complete your exchange. Anybody entering or wanting to do a multiple property exchange needs to really understand the timing of all of the sales and what you're going to be doing on the buy side, because you have to identify what you're going to buy within that first 45 days. So maybe your third property hasn't sold yet. So there's some nuances to all of that. So if you're considering a multiple property exchange, make sure that there's really good communication and understanding of what you have to, deal with when you're doing the transaction. The more common one that we're seeing right now, somebody sells 1 property and they're buying multiple replacement properties. I have clients that are selling a property, for example, and the property that they're selling, they have no loan on it. So it's all free and clear. Now they want to go out and utilize leverage to buy more property. And again, that's an example of the advantages of a 1031, where I'm utilizing leverage to buy more. So if I've got $400,000 and I can utilize leverage to buy, a ton of properties based on what my loan to value will be. You just have to be careful which identification rule I'm going to fall into. All right, so very important to understand the timing of all of this. All right, now let's go over what we're seeing right now as the in the industry right now. Low inventory. Being a seller is fantastic, okay? But you're going to be a buyer in the same market that you've just sold out of. So there's some issues with the inventory levels. So I think it's important when you're looking at doing an exchange, well in advance, you probably want to scout out what area are you looking to reinvest in? What are the inventory levels for that area? Check with Thomas, find out what do you guys have available? What are you seeing? Is a good inventory in these areas where you might want to reinvest? So planning, very important to plan. You want to be aware of what you're going to be going into. What's the inventory levels for that, for that area. If there's new construction, one other thing with new construction, it's important to understand that you have to complete your exchange within 180 calendar days from the date of your sale closing. And there have been instances, of late where because of material shortages, labor shortages and such, there's been a lot of delays when people are buying new construction. So if they're in the new construction and the developer says, yes, we can finish this new construction by, say, January. Well, if you have to complete your exchange by March, you might be cutting it a little too close, because if there's a delay, and I've seen these delays come into fruition, you can't extend your 180 calendar days. So watch new construction if you're going down that road. We've seen exchanges fail lately because they couldn't complete the property in sufficient time for the 180 days. Okay, just understand what new construction is involving. The other item to be cognizant of when you're doing an exchange is, who's my taxpayer? Okay, what entity, what exchange entity am I working with? So sometimes people have property that they acquired, say, many years ago. Say it's a husband and wife, and they bought the property in their individual names. Then they later put it into their revocable living trust. But when they go to buy the replacement property, the lender says, no, we will not lend to you in your trust. Is that a problem for the exchange? No, as long as the trust is disregarded for federal tax purposes, because my taxpayer is not the trust, my taxpayer is the husband and wife. Now, if the husband and wife own the property in an LLC that's taxed as a partnership, and they go to buy the replacement property, they have to buy the replacement property in the name of the partnership, they can't buy it in their individual names. So sometimes there may be lending issues with this. So keep in mind that when you're doing an exchange, the same taxpayer selling must be the same taxpayer purchasing. So there's times where you can be in an LLC that's disregarded, say either a single person or a husband and wife, and then they're buying, and they're in a community property state and they're buying, okay? They can buy individually because it's a disregarded entity. So again, when we're doing exchanges, we're going to be looking at how is the vesting on your title report? Okay, so how are you showing on title? Who's my taxpayer? Do those match? Are the contracts congruent with the tax reporting and the title? These issues come up in an exchange, and I'll tell you they're not perfect. Okay, so you want to, when you're considering selling a property, look at how you're holding title to the property. Consider how you're doing the tax reporting. Does it match? If it doesn't match, if it does not match, then maybe you want to fix that issue before you start even getting down the road. Financing. When you're talking about doing an exchange, if you haven't done financing for a while, I think it's important to sit down with the lender and figure out what you're going to be embarking on. Also be very aware of how much money you have to spend, so how much money you have to put down, because you don't want to get too much of a loan where you're not spending all of your cash. So it's important to sit down with your lender, go over what's coming out of the exchange, how much money you're looking at putting down, okay, to how much they're going to be lending you, okay? So make sure that you're dealing closely with your your lender, knowing how much you have to put down in your situation. And then the other matter right now is the Biden tax proposals. I heard this morning that the House is looking at the Build Back Better plan. Right now, 1031s are not a part of it, so our tax code seems to be safe, but we'll see how it all plays out. All right, so we'll see what's happening with the capital gain rates. So that's kind of what we're dealing with right now. It's still a very big unknown what's going to come out of Washington on the Build Back Better plan. Okay, well, that is my portion. There is my contact information. If you have any questions, please feel free to reach out to me on the 1031 side, or reach out to Thomas and then he can reach out to me, whatever is easier. So Thomas, I'm going to turn it back over to you now.
All right, that was a ton of information. And just remember, guys, this will be recorded and sent out to you as well, or you can reach out to me and have me send the recording. I know these tax-heavy, number-heavy conversations or webinars could be a ton of information to really sift through, but don't worry, you can take it slow and see if there's any questions there. But we'll also be reaching out to you afterwards with questions, or to see if we can answer any of those questions. All right. Now, we do have the property rating ebook as well. I don't know if anybody here hasn't looked into any properties from our website. Again, this is more gearing towards the first-time attendees if this is your first webinar. This is how we communicate our real estate classes, A, B, C, and D. The link to it is right below, super easy, marshallreddick.com/ebook. Quick, easy read. And we always recommend just checking it out before anything else. We also have all of our Learn tab. Now, this is where this webinar will be recorded and set up as well. So you can find any other educational videos, articles, guides, and you can also ask me any questions and I can send you any specific guides which would fit your real estate investing goals right now. All right, and just as Dino said with her, and this would be the next step for you, which was be scheduling a consultation. Now, a consultation is pretty quick. It can be really casual, or it can be super in-depth of planning what your next actions could and should be. Now, we set goals, right? So we find the why. Why are you moving your property in 1031 exchange? Well, I've owned it for X amount of years and I want to get out of California. There's your answer. The how, we look at the different options that you would have. Again, if you are looking to move a single family and acquire a larger multifamily out of state with the pricing about the same, you would evaluate that. Or are you looking for a commercial property, whatever that looks like. right? The when time frame, that's always very important. Again, with regards to 1031 as well, is when you want to sell what, setting your criteria, what your investment goals are, whether that's cash flow or return, where, pick a market, and last of all, introduce you to the key players, which of course Dino would be one of those for a 1031, or a lender to help you get pre-qualified, or a tax professional if you have questions there as well. Okay. There's my contact information following up right there, but I did want to wrap up with a couple of questions as well with a little bit of Q&A. Dino, are you still there?
I am.
Perfect, perfect. I really just wanted to bring this up at the end as kind of a casual conversation because these are questions I get asked on the regular from Marshall Reddick clients who are looking to 1031, and I figured I'd throw them your way to see what your answers might be. So, are you ready?
Yes, I am.
Perfect. I guess first and foremost, the question I get asked the most is, can I 1031 exchange between states?
Yeah, definitely. It's a federal tax code. So anywhere within the United States, you can exchange into Guam and the Marinara Islands. You cannot exchange into Puerto Rico. I know that sounds weird because it's U.S. territory, but anywhere within the United States. So you can go U.S. for U.S., but you cannot go U.S. for foreign or foreign for U.S.
Huh. Wow, I didn't know the foreign part. I knew state to state, but I didn't know you could actually go buy a resort or buy a vacation house in Guam.
Well, yeah, you can, yeah, if you wanted to in Guam, yes, but you couldn't if you were going to Puerto Rico.
Puerto Rico.
So,
Yeah.
or the
Well,
Cayman Islands.
Well, all right. I got another question for you. This one I get asked a lot as well, and there is some semantics to it. So, what if I've converted my primary, so the house you've been living in, into an investment property? Can I still 1031 exchange?
Okay, so that's an interesting question because it depends on when you've taken your primary residence and you've converted it into an investment property. Okay, so you want to make sure that you've seasoned it as an investment property to qualify for a 1031, because we didn't talk about holding periods, because sometimes people go, well, how long am I supposed to hold the property for it to be declared held for investment? And there's really nothing in the code that mandates a specific holding period. So you have to have the intent to hold it for investment purposes. So let's just say, Thomas, that you had your primary residence, you moved out of it, you rented it out, say for 2 years. Okay. Now, if you're a single taxpayer, you know that under the primary residence tax code, you have exclusion of gain of up to $250,000. But just let's say that your gain is more than that. So your gain is $500,000. Because you've converted it from a residence to an investment property, and you have not been out of it more than 3 years, you actually get the benefit of both the primary residence tax code and doing a 1031. So at the closing, you can walk away with your $250,000 tax-free money. I'll use that word on the primary residence code. And then you would do the exchange for the difference. So let's just say you sold the property for $750,000 and say your gain was 500. At the closing of escrow, you can walk away with 250,000 and you can do an exchange for the other 500,000. So it's under a revenue procedure 2005-14 that allows for that. And actually, one of the Marshall Reddick clients a couple of years ago did that very thing.
Very cool. Yeah, another client that we had worked with did the same thing as well. And I'm excited to say I'm recently engaged, so I'm going to bump up that from that 250 to 500,000 shortly. So I'm looking forward to that. I'm actually going to utilize it.
Was that a part of your thing, tax advantages?
Tax advantages. We sat down with the premarital
Single
counsel.
male tax advantages.
Tax advantages is a big part of it, yes. No. All right, last question, and then we'll wrap it up here. Can I 1031 exchange into a new construction property, and can I contract on that property before I close on my down leg?
Yeah, excellent question. I talked a little bit about the downside of the new construction, right? It has to be completed within the 180 days, but I didn't address the issue about when can you get under contract with the new construction. So the key is that if you're going to get under contract with new construction, before you even put your property on the market, that's totally okay. All right, you haven't done anything to hurt your exchange at that point because you haven't closed on anything. You've just basically gone into contract with new construction. Now, what you're going to want to be careful of is that when is that construction going to be completed? So in other words, did you just buy a raw lot, and they haven't even broken ground yet, that sort of thing. Then now you have to figure out what's going to be the timing of when you're going to put your relinquished property on the market, because you don't want to put it on too soon if the construction is going to be long. And you have to make sure that if the construction speeds up, then you have to hurry up and put your other property on the market. But yes, you can get under contract with the property before the closing, before you even got your relinquished property under contract. You just can't close on that purchase until your sale or your relinquished property has closed. So it's a timing issue. And also, Thomas, you can also do that with other property as well, not necessarily new construction. So for example, sometimes people will get in contract with the relinquished property. So they're in escrow, and then they're out there starting to look for the replacement property, and they find a property that they like and they want to get in contract. You can get in contract with the replacement property. In that case, doesn't have to be new construction, but you can get in contract. You just better feel very comfortable that your buyer is going to perform, or you've got extensions on that purchase side. Okay. So it's about the closing of both the sale and the purchase. So that it's the timing issue. So you can get under contract with the replacement property, as long as you remember you cannot close on that replacement property until you have closed on your relinquished property, unless you're prepared to do a reverse exchange, which is a whole nother topic for a whole nother day.
If you have any questions on reverse exchanges, reach out to us here. We've got a client who's debating on doing one of those right now, selling her place in the Bay Area, which she's going to, realize quite a bit of gains on that property for how long she's owned it, and transferring that to a multifamily property. So there's tons of questions. I'm sure there's tons of people who, have questions regarding their personal situations. Again, my contact information is right here. There's my direct phone number as well as my email address. Send them to me. Send me questions, text, call, email. We'll find time to schedule a consultation, and we'll get all those answered for you. So thanks again, everybody. Man, right on the dot, 6 o'clock. Thank you for your time, Dino. It's always a joy to be able to sit down and help educate our clients or work with you. And we look forward to working with you in the future.
My pleasure. Thanks for having me.
All right. Have a great night, everyone. Bye.